All right, Bulls and Bears YouTube family, I am back with another dose of economic reality. Today we're going to talk about mortgage rates. The Fed is allowing rates to spike. Will they continue to spike? If so, you're going to see some effect on the housing market. We're going to talk about the mortgage rates today and where that may be leading us. Also, there's some very serious talk coming out of the money creators about how they're going to fight inflation. Are they just blowing hot air, or is it really something that we should brace for? Well, let's go ahead and get started real quick, though. This won't take too long. Just want to do a quick thank you to the following people that sent me support. They saw the link below and they sent me support. So real quick thank you to the following. First of all, Victor Popoff. That's a cool last name. Popoff, Victor Popoff. Thank you very much. Albert Pack, thank you very much. I hope you don't mind me using your last names. Johnny Shido, thank you very much. You asked me for a shout out. Here is your shout out. Thank you for the support, Johnny. I really appreciate it. And the money that you help me, that you send me, that helps me, I'm going to invest that, and I will check back with you and let you know how I did with that. And I'm going to start sharing my investments more often. We're going to talk about that more in depth in future videos. But today, let's start right here. Mortgage rates. And this is a 1 year chart. We see to the far right here, about 3.57. That's the Mortgage News Daily rate. And you can see the in the blue line there, that's the MBA, which is the Mortgage Bankers Association. And also the Freddie Mac rate in yellow. Now, when we go out to a 5 year chart, we can see that we're still pretty low compared to the average rate looking back 5 years. Also, back in 2020, we did see this spike in mortgage rates, only to be followed by a huge drop and resume back down to all-time low territory. So, are the money creators serious about fighting inflation? Well, you know as well as I know what we need to keep an eye on. One of the things is the mortgage rate. So will they drop it back down after they see the repercussions of the increase, when they see home prices stagnate, maybe even start dropping? Will investors, corporations, and institutional buyers come in and pick up the slack for the people that can no longer afford a home when rates rise? Therefore, home prices still resume higher? Well, at some point, corporations need to be very, very careful about what they pay for homes, because they have to make it so where their rent that they get back is going to cover the property expenses. We're talking about the taxes. And if people can't afford the rent, then these investors, the mega corporations, they also need to be very, very careful. But then again, if they know they're always going to get bailed out in the end, they still may come in very heavy-handed. And that's the problem with market propping, bailouts. That is the problem. It distorts markets to no end. And even when we've seen corrections over the past 10 or 20 years, they haven't been enough of a correction to actually fix the problem, because we did see bailouts, rescue programs, home buyer incentive packages, TARP, you name it, the troubled asset relief program, as they called it back in the financial crisis. Now, speaking of the financial crisis, I think we're in financial crisis 2.0. When you look at the amount of market propping, when you look at the Fed balance sheet, we're already many, many times higher than we were during the 2008 period, which they do refer to as the financial crisis. So I think this is financial crisis 2.0. They're masking it pretty well right now with all the debt that's being created, allowing people to still go out and make purchases by allowing all this debt to happen, all the banks loaning out all this money, all these credit lines, and accumulation of debt. Many of you know this. I think probably everybody knows this. The United States is the world's largest debtor nation. They like to call it the opposite of what it really is. They say we're the world's richest nation, but it's just the opposite. We look rich and we seem rich and we act rich because we have the world's largest amount of debt. And when you go out and spend enormous amounts of money, your lifestyle is going to look pretty extravagant. Imagine if you went out and got a $500,000 loan. You can go buy anything you want. Most people would line their driveway with new cars, and they would look like they're doing very well. They'd probably buy the the most expensive clothes you can imagine, fancy handbags, and they would look like they're doing well, but in reality, it's debt in the background. It's debt behind the scenes, right? So do not mistake wealth, or do not mistake debt for wealth, is what I want to say. And speaking of mega corporations and institutional investing, this was out of a recent article here. Price increases not standing in the way of demand, according to BlackRock. So even though prices are rising and going higher and are at all-time highs in many different areas, people are still buying. So that goes back again to all this, what we talk about here. Why are people still able to buy even though prices are so high, all-time highs in many different categories? It's because debt, loans. People can take out a loan and quote unquote buy something that they normally wouldn't be able to buy if it were not for the debt, if it were not for the loan. So of course you're going to see strong demand when we still have banks loaning out money even at these elevated prices. And that's another wild card. Even if mortgage rates continue to march higher, banks can still just loosen their lending guidelines and allow people to take out bigger loans to compensate for the higher rate, which is going to make people's monthly payment higher. But if they just loosen the guidelines, for example, the debt to income ratio, that could be changed, then they can compensate for that. So it's possible with all these different moving parts that something else can be changed or adjusted or manipulated to offset the rising mortgage rates. And again, rising mortgage rates is a big if. Will they continue to let rates rise? I'll believe it when I see it. So yeah, again, BlackRock stating the obvious. Demand is still there because people still have borrowed money to go ahead and buy whatever it is they want to buy. Now, speaking of fighting inflation, the money creators, the number 2 person at the Fed, Ms. Brainerd, pledges to use, quote, a powerful tool on inflation. And right there, she's talking about the Fed funds rate. All right, so there's a lot of talk coming out of the bankers right now, the money creators saying they're going to fight inflation. We'll find out if it's just talk, but right now we do see these mortgage rates rising pretty rapidly. We look at what they do. We look at rates more than really listen to what they're saying, because talk is cheap. They could say one thing and do just the opposite. So we're going to continue to watch rates for you, continue to watch home prices, inventory. And please stay tuned if you like the housing market news and updates, because we've got another full housing market update coming up towards the beginning of next week. I still want to get some more data here, some recent numbers. I'm waiting to for those numbers to come out so we can give you the most updated data on inventory, prices, etc. So we'll have that one out here probably within the week. Thank you everybody for being here. Quick update today, so appreciate it. Thank you for all your support. Keep stacking. Quick mention. Somebody mentioned that they're stacking toilet paper. Thank you for that comment. When I say stacking, I'm talking about investing. And a lot of people refer to accumulating silver or gold and silver metals as stacking. But thank you for that comment. That made me laugh. You're stacking toilet paper. You're getting ready for the diarrhea apocalypse. I can see where you're coming from. Thanks, everybody. Peace.